Ladies and gentlemen, welcome to the archive. I am the archivist. The date is January 17th, 2026. While you were sleeping, the tectonic plates of the global financial system shifted. You did not feel it because you were watching the puppet show. You were watching the stock market indices paint a green illusion. You were listening to the mainstream financial media recite their nursery rhymes about a soft landing and a resilient consumer. They are lying to you. They are not lying because they are malicious. They are lying because they are incompetent. They are looking at the surface of the water, admiring the calm. I am looking at the seabed, where the fault line has just snapped. Stop looking at the S&P 500. Stop looking at the NASDAQ. Those are lagging indicators. They are the last things to turn off before the lights go out. Look at the bond market. Look at the currency cross rates. Look at the overnight funding markets. The data I have on my desk this morning confirms a single terrifying reality. We are not entering a recession. We are entering a global margin call. The liquidity pump has been reversed. The vacuum has been turned on. And the sound you are about to hear is the sound of the entire world being sucked dry of the only thing that matters in a crisis. Dollars? This is scenario number 9, the dollar shortage. The milkshake theory weaponized. The media tells you the dollar is rising because the US economy is strong. This is a lie. The dollar is rising because the global system is starving. Let me give you the kill shot number immediately. This is the smoking gun that the CNBC anchors are too terrified to read on air. According to the latest shadow banking data from the Bank for International Settlements and the overnight repo desks, the offshore dollar funding gap has just widened to $2.4 trillion. Do you understand what that number means? It means that corporations, banks, and sovereign nations outside of the United States are short $2.4 trillion that they need immediately to pay interest on their debts, to settle trade invoices, and to keep their lights on. They do not have this money. They cannot print this money. They must buy it. And they must buy it from a market that is rapidly closing its doors. This is a $2.4 trillion burn notice sent to the rest of the world. And the United States Federal Reserve just lit the match. Let us begin the autopsy. The forensic data, the evidence, is not hiding. It is sitting in plain sight, covered in the blood of emerging markets. The DXY index, the measure of the dollar's strength against a basket of currencies, has smashed through the 99.3 level. To the uninitiated, this is just a number. To a forensic analyst, this is a siren. When the dollar moves this fast, it breaks things. It is like a wrecking ball swinging through a glass house. But look deeper. Look at the Treasury International Capital data. Foreign central banks are dumping US treasuries. China is selling. Japan is selling. Saudi Arabia is selling. The mainstream economists tell you this is bad for America. They say, oh no, who will buy our debt? They are wrong. They are thinking like shopkeepers, not like warlords. These countries are not selling because they hate America. They are selling because they are desperate. They are selling their savings to get cash to defend their collapsing currencies. They are selling treasuries to buy dollars to pay their dollar-denominated debts. This is a liquidation event. And look at the corporate bond spreads in Europe. Specifically, look at the spread on junk-rated debt for European industrial firms. It has blown out by 45 basis points in 72 hours. This tells me that the zombie companies, the walking dead who survive only on cheap credit, are starting to suffocate. They cannot refinance their debt. The window is closed. The global cost of capital has just reset, and nobody has the money to pay the new price. The war thesis. This is not an accident. This is not a business cycle. This is a kinetic financial conflict. We are witnessing the weaponization of the global reserve currency. I will break this down into 3 phases. This is the mechanics of the slaughter. Phase 1, the vacuum. The Federal Reserve has kept interest rates higher for longer than anyone expected. The market priced in cuts. The market prayed for cuts. The Fed gave them nothing by keeping rates high. The US sucks global capital into its borders. Why would a German pension fund hold European bonds yielding 2% when they can hold US T-bills yielding 5% with zero currency risk? They wouldn't. And they aren't. Capital is fleeing Europe. Capital is fleeing Asia. Capital is fleeing South America. It is flooding into New York. This is the giant sucking sound. It is stripping the rest of the world of liquidity. It is a financial vacuum cleaner set to maximum power. Phase 2, the short squeeze. The world is short dollars. For the last 20 years, emerging markets and European corporations borrowed in dollars because it was cheap. They issued dollar-denominated bonds. Now, the dollar has risen. Their debt has effectively increased by 10, 15, 20% in their local currency terms. Imagine you are a Brazilian manufacturer. You borrowed $100 million when the exchange rate was 5-1. Now the rate is 6-1. Your debt just jumped by 20% overnight. But your revenue is still in Brazilian reals. You are technically insolvent. What do? You panic. You rush to the open market to buy dollars to pay off the debt before the rate goes to 7, but everyone else is doing the same thing at the exact same time. This creates a feedback loop. Panic buying of dollars drives the dollar higher. A higher dollar creates more insolvency. More insolvency creates more panic buying. This is not a market, it is a slaughterhouse. Phase 3, the supply chain freeze. This is where it hits you, the individual. International trade runs on dollars. Letters of credit, the guarantees that allow ships to sail from Shanghai to Los Angeles, are denominated in dollars. When there is a dollar shortage, trade finance dries up. Banks stop issuing letters of credit because they are hoarding cash when trade finance stops. Ships stop. Not because of Houthis, not because of storms, but because the paperwork cannot be funded. We are about to see a seizure in the physical movement of goods, not due to a blockade, but due to a lack of accepted currency. The gears of commerce are grinding to a halt because the dollar has been drained from the engine. The bag holder, who dies first, who is holding the bag. Do not blame the consumer. That is lazy analysis. The consumer is the victim, not the bag holder. The bag holders are specific. We know their names. We know their addresses. Bag holder number 1, the European Central Bank. Christine Lagarde is trapped in a burning building with no exits. The euro is collapsing against the dollar. This imports inflation into Europe. Energy costs in Europe are priced in dollars. As the euro falls, the price of oil and gas in Europe skyrockets. Lagarde has 2 choices. Raise rates to defend the euro and crush the southern European economies like Italy and Spain, or let the euro fall and watch inflation destroy the German industrial base. She will choose to save the bond market. She will let the currency burn. The euro is the bag holder. Bag holder number 2, the Japanese pension funds, the Norinchukin Bank, the Government Pension Investment Fund of Japan. These entities hold massive amounts of foreign debt. They are legally required to hedge their currency exposure. As the dollar spikes and rates rise, the cost of these hedges has exploded. They are bleeding billions of dollars a month just to maintain their positions. They will be forced to capitulate. They will have to sell assets at fire sale prices. They are the whales that will be beached by this receding tide. Bag holder number 3, the emerging market sovereigns. Look at Egypt. Look at Turkey. Look at Argentina. Look at Pakistan. These nations have dollar debts and local currency revenues. They are mathematically bankrupt. The IMF cannot bail them all out. The numbers are too big. We are looking at a cascade of sovereign defaults. And who owns their debt? Western asset managers, BlackRock, Vanguard, your 401k. You are the final bag holder if you are holding diversified international bond funds. You are holding the toxic waste of a dying system. The protocol. The system is correcting. It is ruthless. It does not care about your feelings or your retirement plan. It only respects physics. The resource denial protocol is now active. Here are the rules of engagement for this environment. This is not financial advice. This is survival intelligence. Rule number 1, duration is death. Do not hold long-term bonds. If you own the 30-year treasury or the 20-year gilt, you are gambling on a pivot that is not coming fast enough to save you. The volatility in long-duration assets will be stomach-churning. When the foreign selling intensifies, yields on the long end will spike. Price goes down. Stay short. Stay in T-bills. Stay in instruments that mature in less than 6 months. Cash is a strategic position. It gives you the optionality to buy the wreckage later. Rule number 2, short the zombie alliance. The European banking sector is a house of cards built on a swamp. Look at Deutsche Bank. Look at Societe Generale. Look at Santander. These banks are exposed to the rotting industrial core of Europe and the collapsing commercial real estate market. They are dollar-starved. If you have exposure to European financials, you are standing under a falling piano. Get out. Consider inverse ETFs that target these sectors. Bet against the fragility of the Eurozone. Rule number 3, embrace the dollar wrecking ball temporarily. For the next 30 to 90 days, the dollar is the only game in town. The UUP ticker, the bullish dollar fund, is the simplest way to ride the tsunami. Do not marry this trade. It is a trade, not a marriage. The dollar will eventually break the world, and the Fed will be forced to print trillions to restart the system. But for now, the trend is your friend. The trend is a vampire sucking the blood of the world. Be on the side of the vampire. Rule number 4, the physical pivot. This is the most important rule. The dollar spike is a deflationary shock. It will pull down the price of everything initially. Stocks, real estate, and yes, even gold and silver paper prices may take a hit as hedge funds are forced to sell their winners to pay for their margin calls. This is the liquidity flush. Do not panic if you see gold drop to $4,200 or silver dip to $80. This is the ultimate trap for the weak hands. You must use this dip. When the paper price drops because of the dollar squeeze, you must buy the physical asset. Buy Freeport-McMoRan FCX, buy Barrick Gold. Buy the physical metal itself. Because when the Fed inevitably pivots, when they realize they have destroyed the global banking system, they will print money on a scale that will make 2020 look like a joke. They will flood the system with liquidity, and the dollar will crash. And real assets will go vertical. You are buying the insurance policy while the house is still smoldering, just before the fire department arrives with the gasoline. Rule number 5, supply chain defense. Look at the companies that own the domestic infrastructure. The ships are risky. The ocean is a war zone. Look at the rails, Union Pacific UNP, Canadian Pacific CP. Look at the domestic fertilizer producers like Mosaic MOS. If the world breaks into fragmented trading blocks, you want to own the companies that move essential goods inside the fortress North America. Stop betting on globalism. Globalism is dead. It died this morning at 2:30 a.m. The final engagement. The phase shift is accelerating. The entropy of the system has reached critical mass. The headlines will distract you with politics. They will distract you with celebrity gossip. They will distract you with green shoots. Do not look at the screen. Look at the ledger. The ledger has a $2.4 trillion hole in it. The debt collectors are coming, and they are not accepting soft currency. I want you to do something for me right now. Walk into your kitchen, open your pantry, look at the shelves. Imagine the trucks stop for 7 days. Imagine the ships stop for 14 days. Count your calories, count your medication. Tell me in the comments below, what is the one specific item, be it coffee, antibiotics, or ammunition, that you absolutely cannot survive without, and that you do not have enough of right now? If you have to think about the answer, you are already a casualty. The insurance adjusters have left the building. This is the archivist. The protocol is active.